All right, good afternoon, folks. Thanks for joining us here on Thursday afternoon, and to our friends on the Central and Mountain and West Coast. Good morning. We're here to conclude our three-part series of using emerging legislation to spark life insurance sales. So in parts one and two, we kind of set the table for what's to come. A lot of those things and details are starting to rear their heads through different bills that have been presented to both the House and the Senate. Um, Part two of three really dialed in on income taxes and what we can do to combat potential step up and base, the loss of step up and basis and different income taxation issues. And today, I'm joining me here is my partner in crime, Adam DeMarco. We're going to dial in to purely product solutions that we've been using in the strategies we've covered during sessions one and two. So, this one is going to be a little bit more interactive. I'm going to lob Adam some questions, and you're going to get a perspective from the product guru, who we've dubbed in our pre-headers as the wizard behind the curtain. So, to keep on task here and get you out of here by 12:40, we've set forth a four-part agenda. The industry is going through some change. There has been a significant demand for life insurance product. However, for the first time in my 22-year career, I'm starting to see a lack of supply by the manufacturers and the insurance companies. So we're bringing Adam in here to shed some light on what we can do to overcome some of these issues. And I'll dive right in. With persistently low interest rates, further exacerbated by COVID, the insurance companies really don't have a place to park their premium dollars, and therefore are limiting the amount of dollars we can contribute in year one. This impacts the large case market tremendously. You have companies like prestigious companies like Prudential, whom arguably had the biggest reach in the reinsurance super pool, limiting first year premiums to $500,000. And what I have on the screen here is just data that we keep, and this is a moving target, and this isn't just isolated to a Prudential issue. This is an industry issue. So, Adam, give us your perspective on how you can overcome some of these first-year premium restrictions when you're designing a large case.
Yeah, so a couple of things that you can do is if there's no gain in the contract, we could look to surrender it and to put it in over a number of years to get around it. But oftentimes 1035 exchanges are older policies with gains, so that's not going to be cost effective. We can spread those gains over a number of years with a single premium annuity, where you would you might do a 7-pay or a 10-pay period certain and fund a contract that way. But the most efficient for the client sometimes would be to do split 1035. So most carriers allow split 1035s on the way out, and most carriers allow incoming split 1035s too. So if we could maximize the contract, then we might be able to go to, let's say, AIG, who has a maximum of $1.5 million, and it was a $2 million rollover. Well, we might take the first $1.5 million and go to AIG, and then the next $500,000 and go to the next company, as opposed to doing $2 million in one company.
Thank you, Adam. So just to reiterate, you're looking at the higher limits on these charts, and you're gonna send the bulk of the money or the entire 1035 over to one of these companies with higher limitations, and then structure and set up policy number two, which will be the premium paying contract. So you'll be running a dual policy approach.
Yeah, so what we do is generally the price, there's price banding to a certain extent, but not at these levels. A $100,000 1035 is a huge transaction. That's a big case for everybody involved. So what we'll do is we'll just do fractionally. So if it's like a $1.6 million rollover, we'll test the market at 160 on a rollover, knowing that who's the best per 1/10, and then we can just extrapolate it and find the best combination of things you don't have 18 different policies, but most of these limits are, reasonable. And if you're just exceeding them, we'll figure out a way to maximize it. And through the split 1035 approach is probably the best because it's going to avoid any taxable gains. And there are instances, though, where either the surrender or the spread by way of the annuity is going to yield better results. And we'll probably talk about that a little bit later with some of the different funding strategies. But sometimes companies have not only put this first-year premium restriction in, they've actually put some adverse policy expenses where they don't want all the money up front. So I think, we're going to cover that a little bit later. But we're going to look at every direction when we're getting money in, particularly when there's limitations as coming in.
Thanks, Adam. Great insight. Very creative. The second question I wanted to throw your way is, the industry is going through a bit of a migration away from long duration guarantee contracts, and the policy of choice over the last decade or so has been what's known as GUL. And Adam, we're seeing first companies start pulling out of New York in the GUL space because of reserve requirements and persistently low interest rates. And now, unfortunately, we've seen the migration out of GUL products outside of New York. Some companies have left the market completely. Give us your perspective on some alternatives to long duration GUL products as we've known them for the past several years.
Yeah. So all the compliance and the reserve requirements that's been put on the insurance companies, they only pertain to fixed products. So variable contracts they're superseded by FINRA, and the SEC is overseeing them. So the variable products you'll find with lifetime guarantees and cash value potential and accumulation potential with the sub-accounts, the variable products are actually better priced than the fixed products a lot of times. So that's one opening, is just to say, we're going to move, for advisors that are registered reps, it will move to variable contracts that have the old type pricing, or that are more profitable for the insurance companies to offer a competitive rate. But for fixed products, or for clients not looking to do variable, or there's a whole group of agents in the market that aren't licensed to do that, you have a lot of what we call life expectancy based guarantees and beyond. This market used to go to 85, 90, and then they've migrated basically anything under a 121 guarantee, age 121 guarantee, has a different set of reserve requirements than the truly 121 guarantee. So contracts going with a guarantee to 100 or 95 or 90 are very common now. And where 5 years ago we had two companies in that space, we have almost every company is either migrated to that completely, or they have an option for one of each. And we're going to see some carriers next month that are going to have increases on 15, 17% increases on GUL contracts, because they're basically going to incentivize clients and agents to go into these life expectancy based guarantees. And in talking with producers over the past 10 years since these products have been more popular, these ones, we had a lot of pushback initially, because people wanted the lifetime guarantee. But as lifetime guarantees got more expensive, and these life expectancy guarantees have gotten not just the lower cost option, but they pushed the guarantees out longer, it's pretty commonplace now. We're selling more of this type of product than GUL for the first time. I mean, to give you an example, GUL was about 11% of our premium last year. It was never under 25% in any year that we've been in business, which is, in this entity, has been 8 years, and I've been in business for 16. So it's just become cost prohibitive. And the lifetime guarantee, all else being equal, you would want that. But a guarantee to 100 on some of these long duration alternative contracts, having IUL or fixed UL crediting and fixed UL nature in the contract gives you flexibility. It gives you cash value. You'll see in that second example that it does maintain some cash value in the IUL, say to 100. And then if you're willing to go with a lower guarantee to 95, to 90, to 85, there's some contracts in that space that'll be significantly less. And you could see that it's at least a 10% difference. And when you go into doing, going back to the previous slide, when you go into rolling in lump sums or 1035 exchanges, it could be night and day. I mean, you could be talking about 30, 40% differences. So the flexibility, the cash value, And ultimately, a long enough guarantee, it's made that marketplace really it really shine lately. So
Thanks, Adam. So, Adam, if you don't mind, I'm going to take this one. The IUL Cap Dilemma, and you're going to see a bunch of content come out of Life Brokerage on this over the next week or so. Just about every quarter, you're kind of looking over your shoulder at your annual statements or a carrier announcement that involves a decreased cap. I'm going to just take you on a quick trip down memory lane. This is a chart we put together last week. The first IUL product was released, believe it or not, in 2007, and I'm sorry, in 1997 by Transamerica, and by 2008, end of 2007, beginning of 2008. I would say that the majority, every major carrier had some version of IUL. And there were 40 plus IUL contracts available by April of 2008. Now, the environment in 2008 looked very different than it does today. At the onset of the first version of IUL that I mentioned that Transamerica released in 1997, the 10-year Treasury was above 6%. When the majority of the market had their IULs being manufactured, 10-year Treasury was at 3.57. So allow me to just kind of walk through this for a moment. At 3.57 with the Treasury and the VIX, which averages 20%, this is the index that manages volatility, that identifies volatility. Even with the VIX above average and the 10-year Treasury of 3.57, carriers could offer a 14% cap. So with a 14% cap and a 0% floor, if I looked at 10 years of simulation in a Monte Carlo with 80% confidence, we could illustrate 7.82% crediting within our IUL products. As you know, the vast majority of these years have been positive years where, in fact, 10 out of 14 times we've actually hit our caps. But if you look at the trend in interest rates start to dip around 2012 and then really hold at that 2% level, you can see that the long-term persistently low interest rates and current high volatility with the VIX at 26 yields a cap offering of approximately 8%. There's recent announcements been out just as soon as yesterday. Another announcement will be released tomorrow where these caps are going to reduce to 7.5. So our 80% confidence is now 4.79. From the 7.82 to the 4.79 is a very significant change to our IUL products. Now, again, this is not the time to ambush capped IUL products. These products have done extremely well, and despite the aggressive nature of our illustrative designs in the carrier software, we've actually exceeded expectations. So, again, this is not a message to attack or ambush capped products, but it is a lesson on history. And if past history indicates future results, we can further expect these cap rates to continue to decline, given the debt that we discussed in Joe Ross' seminar just a couple weeks ago, and the continued volatility. Combine that with statements from the Federal Reserve, and we don't see interest rates climbing anytime soon. So what does that mean? The industry is now, as we've migrated away from GUL, we're also starting to migrate away from capped accounts and introducing uncapped strategies. And the goal and objective of the uncapped strategy is to lower or remove the volatility so that carriers can now offer a more affordable strategy that does not have a cap. So just a quick lesson on caps. If you have X amount of dollars set aside in your savings, or let's use the term reserve, and the yield on that goes from 6% down to 1.6%, now you have less working capital to go out and buy options. If the cost of options increase from where they used to be because of market volatility, and you have less earnings off of your asset, you cannot continue to afford to buy caps at 14% like we did in 2008. So the market dictates where the caps go. It's not the insurance carriers being good or bad or indifferent. It's just the factor of the current market. So what these volatility control accounts do is look to mitigate these challenges in 4 different ways. One, they target a volatility percentage, and most of the uncapped strategies target 5%. So if the index is moving plus or minus more than 5%, they start to pull back. Think of I just bought my kids a go-kart. So think about adding a governor to the go-kart, where they start hitting certain speeds that become dangerous. The go-kart can automatically pull back into a safer place. That's exactly what these volatility control indexes do. They allow the professional investment banker to start taking dollars off the table from the equity side of the house and move it into a 10-year treasury or risk-free or interest-free cash accounts in the event that the trend of the 10-year treasury is headed in the wrong directions. So target volatility, remove, another strategy would be to remove completely the most popular and volatile of the, call it 500 S&P companies, and rebalance with the least volatile. So if I remove the volatile and the popular ones, I reduce the cost to purchase the option, which allows me the ability to eliminate the cap. Thirdly, you can pay a spread, right? This is the tax man, or this is your admission fee per se. Call it 3% spread, which means you can participate. These products focus, these segments focus only on the S&P. You participate in all the S&P growth, but only after you pay your entrance fee. And in most instances, the entrance fee ranges from 3% to 10%. 10% arguably is a very expensive entrance fee. So if the S&P goes up 20%, you're paying the first 10. You're not paying, but you're not crediting. You're not receiving credits for the first 10. You're left with 10. And the 3% spread accounts, which are much more economical, if 17% growth, you pay 3% spread, you receive 14% interest credits. And then lastly, there is a methodology where you can introduce a blend of different allocations and asset classes instead of only the S&P 500. So the S&P 500 is equity based. It's the most expensive cap to buy. If you can allocate between fixed income, commodities, and international, then the cost of those options also decrease. You're smoothing out your ride. These are all electronically controlled. It's not someone kind of guessing on a whim sitting up on Wall Street to rebalance during the most volatile times. And they're gaining in popularity with the continued declination in cap rates. So, a solution to this problem, there are a lot of policies were written using LIFE strategies, premium finance, private split dollar, corporate split dollar. So, the solution again is not to ambush and replace completely, but if your caps are suffering and the products have performed extremely well over the last several years, you may want to optimize that existing IUL contract by just simply either changing the face amount option to level, reducing to the minimum non-met corridor, and then open a new policy where you're diversifying new premium or new money into that uncapped strategy of choice, so that you're running a dual policy approach, just like Adam described in the 1035 example. We would be doing this similarly here in this cash value or income focused design. And Life Brokerage can certainly lay this out for you. Adam, I'm gonna push this one back to you. So we talked about some different ways of gifting money to trust to acquire life insurance in part one of our webinar series, and we use some different wealth transfer strategies such as gifting and lending and financing and installment sales. Given the product challenges that we're faced with, of late in our industry, I wanted to get your perspective on how to align some of the product solutions you work with some of the strategies that we talked about in part one. So give us your perspective. This is for a client who has the means to gift. They feel like the clock is ticking. How do you get the most bang for your buck if you're able to make that gift of, call it 11.7 million per taxpayer before the Bernie Sanders bill kind of hits the news feed? What can you do with those funds, Adam, once you get them to trust to maximize the return to your beneficiaries?
Yeah, so the product of choice in the estate planning space for estate tax liabilities is generally survivorship insurance. It's a low-cost contract. It's on 2 lives. The tax occurs on the death of the second spouse. So, this product is something we've been doing for a long time. So and oftentimes clients, particularly younger ones in this example, around 45 years old, they look to not be saddled with this premium for life on it, and they short pay contracts. So when you short pay a contract, the IRR, if you live long enough into your 90s, it all kind of equals the same. When you look at full pay strategies, you're working with the same cost of insurance, the same rates of return, everything's kind of the same, right? So if you live long enough, it all kind of evens out. In the short-term contracts, short-term funding, you pay less, but then you paid more and you lost the opportunity cost to pay up a policy. If you pay for life, again, you're saddled with the premium. But for clients like in this example that we're looking to do a short pay, what we found was that even within the same company, doing a modified short pay was actually better. So in this example, 1A and 1B, they're actually the same contract. We found that the expense loads in the contract were actually higher in the first few years. So we could actually pay less in the next 5 years, pay a catch-up premium in year 6 to 10. Generally, catch-up premiums will have, lost interest charges for the insurance company. They actually was discounts. It was lost interest discounts, basically, for the insurance company because they didn't want the money up front. So the cumulative premium was about $100,000 less on policy B versus policy A of the same contract. So all we did was find out when the insurance company wants to get their money and gave them their money when they wanted it. Generally speaking, I'd rather have $1 today than, 10 cents over the next 10 years, but it's changed. That's not the case anymore. So companies don't want money up front, particularly 1035s or large lump sums. A lot of them put expenses where it's better to put that money over a couple of years. So options 1A and 1B are just the same contract of us just finding a better way to fund the exact same 10 pay. But an alternative to the 10 pay would be a graded premium. So it's the opposite of it. On a short pay or a 10 pay, you want to get all your premiums up front, right? On a graded premium or a step premium, what we're going to do is we're going to pay as little as possible for as long as possible, knowing that if we have longevity, if we live a long time, you're kind of kicking that can down the road. Eventually, that premium is going to be due, and you have to pay these catch-up premiums. But you can see in the example policy 2, even though you've cumulatively paid more in over time, especially if you live out to age, in this example, living out to age 90, you still get to push the IRR at life expectancy and beyond a couple points higher. So for clients that are chasing IRR and that are just looking at the pure return of it, it actually makes sense to pay as little as possible and just build that liability later on. We also sometimes will look to contracts that have return of premium riders as well, where they'll get their premiums back. They're even more expensive catch-up premiums, but you could drive double-digit returns, out to age 90 sometimes in those contracts. And then on the right side, policy 3, that's a variable contract. So in some instances, policy 3 will be cheaper than policy 1, like we mentioned earlier. In this particular example, it's not, but sometimes the variable contract will be cheaper on a short pay than the fixed contract, depending on carrier and age of the client. But the value of the variable contract is you get all of the same guarantees as a fixed guarantee, and you have cash value potential. And if the contract performs, the death benefit can increase substantially. So in this example, to 8% variable growth rate, if you did have an 8% variable growth rate, by the time you're, in your mid 60s, it's actually going to push the corridor limit. The cash value would be so much on the 2.7 million you put in that it's actually going to start to increase the death benefit, which has some wonderful benefits long term. If that continues, you could just continue having rates of return that could be, the highest available, basically. So the options are you short pay a contract, and if you're going to do that, let's make sure we do it in a way that the insurance company wants to receive it. Again, paying less upfront and paying less over time sounds odd, but it's just the market we're in. It's the way these contracts work, not necessarily the way they designed them, but the way we figured them out. Then if you want to chase better returns or better performance, we could look to do that on a variable basis with some underlying guarantees. So or we could look to do that by just paying as little as possible, knowing that if you have longevity and live a long time, it's going to cost you more money over time, but the IRR is still going to be higher. So if you're an astute investor and you could do something better with your money, which people with estate tax problems that are buying $20 million policies likely would fall under that category, then the graded approach is very popular and could yield the best results, as you could see. I mean, again, another point or so in at life expectancy or two could make a big difference to the family and the heirs. So we look at all these options, and it's their plan, not ours. It's just our job to show them what's out there, and we would show this and to 10 different people. We might find that people are going to be picking different things depending on what's important to them.
Thanks, Adam. Yeah, I think sometimes we forget these contracts are flexible premium adjustable lives, not level premium adjustable life. So it's a great strategy for new contracts. But Adam, how about existing policies? Like this young woman at age 61, the beginning of the year, age 62, the end of the year, purchased a GUL contract in March of 2015. Is there an option for her to pursue this graded design?
Yeah, it depends on the carrier, but some carriers respond better to the graded design. Like I said, they like to for a number of reasons, insurance contracts like to receive money in different ways. Some don't like it in the early years. Some don't penalize you for not paying it. Those are very interesting. There's some contracts that have what's called a zero interest catch-up. It hasn't been around for a while, but they do still exist, particularly in-force policies, where literally every dollar you don't pay subject to the minimums, you could always just pay back later with no interest, which is wonderful, because then we could do something else with that money, and then if you live long enough, we'll just put it back in. There's no harm. Some contracts will have adverse effects for if you don't pay $1 or you don't pay a full premium, they could go off the rails pretty quickly. This particular example is a contract that responds really well to the graded premium. So if you have a client who has, depending on the type of contract they have, maybe things have changed with their business. We've seen so many businesses affected by the past year. Maybe things have changed where they have better investment alternatives, or they want to, try and leverage their premium dollars elsewhere and still maintain the coverage. Universal Life says that subject to a minimum, you could pay as little as possible, and the contract's still going to pay the full death benefit. It's not going to incur loans like a whole life contract's going to, and it's not going to lapse as long as you're maintaining some baseline guarantees. So what we did in this example is the client, paying $87,000 a year. We figured out what is the minimum to get it to go out to at least age 81. And then after age 81, we start increasing the premium. So you could see that we're going to save in this example, significant premium dollars over time. And we can even show a side fund growing. But, if you live to 100, it could cost you, $700,000 a year. So you just have to be mindful of those catch-ups. But if the contract responds to it, none of this stuff's irreversible, and that flexibility, that savings could be huge to clients. So any client that really has any GUL, if they're having a cash flow issue, if you're looking to just get more aggressive and try and push the IRR life expectancy, maybe they had a health change, right? Client might have bought a policy and been preferred at 62, and at 72, they might have significant health issues. I wouldn't be in a rush to go putting full premiums into a contract because it is flexible. We just want to make sure we know what the impact of that is. And it could be all over the map. And again, we've seen contracts where paying $1 less than the guarantee can trip the contract and cause some problems. And we've seen other contracts where you could literally pay nothing for many years and just pay back what you didn't pay with no impact. So it just, it really just builds in the need and the importance of doing reviews and getting a little bit creative on the reviews to look at alternative funding patterns. And obviously, if we could save clients money, we could redirect that to a number of things, including maybe getting them more insurance or different types of insurance that would complement them with multiple policies. But we start with trying to make the current policy as efficient as possible.
Thanks, Adam. Now we talked about, and Adam, I can take this one. We talked about lending money to trust, and for clients who are aware that exemption issues are on the horizon, but they're on the younger side, or they're just simply psychologically not ready to part with their assets in an irrevocable gift, can absolutely just make a loan to their family trust at extremely favorable interest rates and purchase life insurance. We're going to want to create those policies with liquidity early on. You're going to probably want to use a premium deposit account if it can hurdle the risk-free rate, and give clients optimal flexibility, control, and maintain a significant amount of death benefit outside of the taxable estate. The purpose of building a liquid policy is that you could repay the grantor their loan in installments or in a lump sum in the event they want their money back or had a change of heart. And if the tax law does change, then you can very simply just tear up the promissory note and complete the gift, as you would any other normal gifting strategy. Section 7702 has brought about some different opportunities in those types of strategies where, if there is a rollout or a cost recovery requirement through corporate split dollar or private split dollar or key man strategies or premium finance, any strategy that involves some type of crawl out or rollout, we're finding 7702 is creating higher yield in the early cash values, getting some better long-term performance in the cash value side of the equation, but it's requiring lower face amounts in the non-MEC solve for the same amount of premium. So you're not getting as much death benefit in these advanced concepts. So again, just like we talked about in the 1035, the split 1035 dual policy approach to the capped IUL dual policy approach, we would do nothing different here. The cost recovery would be just a pure death benefit separate policy for the employer or the lender or the donor or the grantor, whomever the recovery needs to occur with. We'll buy one policy to cover cost or the rollout, and then the optimal cash value policy using a post 7702 modified product for the performance. So you're kind of bifurcating the needs here, just like it's been the theme of this webinar. Stay creative, conduct your reviews, work with your life brokerage marketer on any issues or in a consultative fashion to talk through different opportunities that may yield a new sale and put your clients in a better position. Today's session has been recorded. We thank you for your attendance and wish everyone a terrific remainder of the week. Stay safe, stay healthy, happy selling.